Good morning, folks. It's been a fairly newsy week, and I found that every day's newspaper had at least one article that I wanted to share with you. But markets have been relatively stable in the interim, though I will tell you all about it as we go through. Monday's headline, little gloomy, says India Inc. Q4 earnings beat estimates, but growth slows. Yeah, so analysts were not expecting even as good a performance from companies in the Q4, but did a little better. Doesn't mean to say that we are very happy about it. So you see, analysts were only expecting about a 1 to 5% kind of growth in Q4 on profits, but actually companies reported 6.6% earnings growth year on year. Okay, this is the sum total of 1,555 companies, listed companies that have reported their Q4 profits. So this is not really great because Q3 and Q4 we've been seeing hardly single-digit growth in revenues. It doesn't bode very well. So I think the slowdown is caught on, and the estimates are that FY26 as a whole will also not see any major fireworks, and we may end up with only a single-digit kind of earnings growth for the whole of FY26. But of course, as analysts tend to be, they are more optimistic about the future. So FY27, 28, etc. The consensus is that the Nifty will at least see a double-digit earnings growth in those 2 years, maybe around 13%, 15% kind of earnings growth for those 2 years. The report does say that mid-cap companies have done better in Q4 than the large cap in terms of earnings growth. They've reported about a 20% earnings growth as compared to a 6.6% earnings growth in the large companies, mostly led by the smaller sized banks that are there in the mid-cap universe and IT. So a number of mid-cap IT companies have reported good earnings, almost on an aggregate about a 47% increase in earnings for the mid-cap IT companies. So these have really led the mid-cap. But if you see that overall, as the data says here in the article, the entire pool of aggregate of profits of mid-cap companies is hardly 1/3 of what the Nifty large cap companies generate. So you really can't compare the two. They still are a very small part of the profit pool, overall profit pool, and so hence a large cap will continue to drive the earnings. The one slightly disturbing fact that has come out of the Q4 earnings is the substantial part of the earnings growth, 73% of the earnings growth, has been driven by just a handful of 5 companies, led by Bharti Airtel and Indian Oil and Hindalco. So it does show that it is not a homogeneous growth, whatever we have seen also, and we are going to see a lot of spikes, which not great news. We would like to see more uniform earnings growth. Is it not? So that's where we are. And then given all that has been happening as far as the US is concerned, there's an article here after the US government credit rating fell by Moody's. Is it time to rethink the US market exposure in your portfolio, is the headline. When many investors speak of global diversification or offshore investing, they only think of the US. And hence, I guess this article, which means that if you want to really diversify, then you should be in countries other than the US also, too, so that you really have, you're protecting your downside and getting the global diversification that you want. And so with the kind of debt downgrade that has happened, the weakening dollar that is happening, and we should also remember that the Q1 GDP growth shrunk by 0.2% for the US. Okay, so obviously, if you're only focused on the US for your offshore investing, you should be looking at other countries also. And some of the wisdom that is coming out of this article says that you should have at least 10 to 20% of your portfolio in offshore in other countries to get global diversification. And if you have only US, then it is definitely time to look at having other countries in your portfolio. No doubt about it. And this is but you cannot really run away from the US or get it down to zero. US being the largest economy in the world, the largest consumer in the world, and the country where most of the innovation happens. So one of the reasons we want to look at global diversification is that we don't have so much innovation happening in India. We don't have the variety of companies in India that we get outside. Hence, you need to be looking. So yes, US will be there as part of your overseas portfolio, but let it not be the only country and let it not be the majority of the thing. That is what this article also tells us. And as we go through the next day's newspaper, and brighter headline, it says FPI inflows so far in May is the highest in 8 months. So we almost saw about 2.2 trillion rupees moving out in the previous year. And so suddenly when we have about a 14,000 crores inflow, we feel good about it. The general trend has been of reducing FPI inflows into India, most likely because of the higher valuations here. They've been booking profit and they've not been buying as much. But after the kind of stability that has come in, number one, because of the conclusion of the US-India conflict, at least for now. So given that is not there, greater confidence. Number two is that with all this chaos around tariffs happening, India as an economy has not really been impacted. So that resilience is showing up and the conflict is behind us. So there's a greater confidence for foreign investors to come into India, and that is being shown. By the way, if India attracted about $1.6 billion in FPI. Brazil attracted $1.7 billion, and Taiwan attracted $8 billion. So we are number 3 in that list there. So we are not the highest. We are at number 3. But then let's see how the other countries have done. Brazil as an emerging market in Latin America, South America has been doing pretty well. Okay, in terms of its stock markets. I don't know if you've been following. Last month, there was a day when most of the power grids collapsed in Spain and Portugal, and we didn't know why. The country, most of the capital cities were thrown into chaos because of that. And it turns out that it could have been because of renewable energy, which is a large component of their power grid, and that is erratic. So when it falls or goes up in suddenly, the grid could collapse. And that report is being studied closely by India too, because it turns out that half of India's installed power capacity comes from renewable energy. So yes, the authorities in India are studying carefully to see that we don't have a similar problem anytime in the future about this. Okay, renewable energy means non-thermal energy. It includes hydro, solar, wind, etc. Inside, signs of stress. Microfinance disbursements in Q4 fell 38%. Okay. Microfinance is one of the most sensitive and riskiest of the loan portfolios, whether with banks or NBFCs. Banks have actually been using NBFCs to do them unsecured microfinance lending by lending to NBFCs for these portfolios. It's very risky. The slightest signs of trouble, these portfolios start defaulting. And the Reserve Bank of India had cautioned all the banks and NBFCs that they should be looking carefully at their microfinance portfolios and have a higher provisioning for microfinance. So it sort of was a wake-up call for banks, and they have been, yes, because of higher provisions, they would rather not lend as much to microfinance. So we do see that microfinance disbursements fell sharply by 38% year on year in the Q4. So in the previous year's Q4, 1.15 lakh crores were disbursed, and in the Q4 of FY25, 0.71 lakh crore was disbursed. So these are unsecured loans, very risky. They only do it because of the very high rates of interest that they are able to earn out of this. But one should remember that the risk is there. So a number of microfinance companies offer higher rates of return on their bonds, but one should remember this is the underlying risk. So are you getting a high enough rate of interest for the kind of risk these companies are taking? Always keep that in mind when you're looking at it. In our last podcast, we had spoken about the tax on US immigrants for any remittances they make outside of the US. And that was at that time about 5%. But subsequently, the bill got placed in the lower house, and with some modifications, that 5% came down to 3.5%, which is still not great. So this edit says taxing time for migrants, and it wonders what is the rationale for doing this. Is there an economic impact or not? So the stated reason is that government wanted to protect dollar outflows. But these remittances for US are hardly 1% of their GDP. It cannot make a major impact. Whereas for India, for the recipient countries, they're large. I mean, there are about 5 million Indians in the US who hold either F1 visas or H1B visas, and they would be remitting money back to their home country, and also green card holders. And they remit about $32 billion every year to India. Okay, for either supporting their families or making small investments here, buying homes, etc., etc. Okay, and the US accounts for about 27% of India's inward remittances. So if we are, but at 1% of GDP, it doesn't make any sense for US to do this. So it does feel that it is not an economic agenda, but more an anti-immigrant agenda, which has driven this decision by the US government. Let us see. The edit also throws up an interesting point. So India, in its making itself a friendlier tax deal with the US, said that they would not have this Google tax. Okay, the Google tax of 6% was on online advertising, not only on Google but on any online advertising. There would be a 6% tax, and they scrapped it as a gesture of reciprocity ahead of a trade deal. But while India has scrapped the online advertising tax of 6%, US has gone ahead and proposing a 3.5% remittance. Doesn't feel so good. So there may be some back and forth going on this before something happens. But is it fair? It does not seem to be fair by any count. Okay. In the same day's edit, Rama Bijapurkar, one of the most well-known marketing experts, market research experts, talks about directions in household consumption. Okay, this has been a fair amount of debate almost every week on what's happening to consumption. Okay, so here I'm just writing. Although leading FMCG companies called out weak urban demand, the Kantar Consumer Track reports that urban demand is not slackening, but households are down trading from high-priced big brands to local, unbranded, cheaper products. Very significant finding. And earlier, the rural demand was not good. The consumer sentiment in the rural areas was mildly pessimistic. That has come back to neutral. Okay, and though both have been growing, the quantum by which rural demand is growing is far more than urban demand. And given that we are likely to have good monsoons, it speaks a little more positively for rural demand here. Says JP Morgan turns upbeat on emerging markets. So they've been changing the stance, and now they're a little more positive on emerging markets. Okay, so it says at a broader level, its change in stance as regards the EM universe is a confluence of factors. Firstly, JP Morgan believes that the worst of trade wars is over, even though there could be some noise related to the tariffs going ahead. Secondly, it expects the US dollar to stay soft this year, and a soft dollar is generally helpful to emerging markets. Okay, emerging markets historically traded inversely to the dollar. Okay, the big question is whether the last 15 years downtrend in emerging markets and the strong dollar could be ending. Okay, so EMs generally have been underperforming developed markets since 2010, and this entire period the dollar was strengthening is what data shows. So if we see that the dollar is going to be softer and weaker as the US administration, I think, wants it to be, it could be a good sign for EMs. But the other thing that has been also happening is that yields in the US are moving up continuously, whatever happens, and a stronger that could lead to a strengthening dollar eventually, if not immediately, which is not good. So what could also happen is as yields go up higher and higher, which is not great for the US government because it has to borrow at higher returns. The US Fed would then step in to reduce rates. Okay, so we're saying that at some point of time, all these three factors will converge, and it could be better for the emerging market, is what JP Morgan says. Okay, also says that the emerging market valuations appear attractive at 12.4 times forward PE versus developed markets at 19.1 times forward PE. Okay, and global investor positioning to EMs is low, in particular to China, and we all know why China is taking a lower, because the confidence levels, given the geopolitical problems and the trade wars going on, then not a great motivation to invest more into China, though valuations are attractive. And we think that over time, you could see greater attraction for China as things settle down. So we've been seeing a lot of flip-flops. We initially thought that the trade talks between US and China held at Geneva were good, but during the later part of the week, the whole good sentiment reversed. Similarly, we thought something good is happening with the Russia-Ukraine war, with peace talks likely to happen. The whole thing reversed with the German chancellor saying with Ukraine and Germany will jointly produce missiles, long-range missiles, which will enable Ukraine to strike deep into the heart of Russia, which is not good for anything. So we are seeing a lot of flip-flops within the week, and that has been also been roiling markets. Good news comes, markets go up. Bad news comes, markets fall. And at the end of the week, we are neutral. Nothing has happened. Okay. So the IMD in India has raised the monsoon outlook to 106% of long period average, which is great, right? We all know that monsoons are at the heart of Indian consumer demand and inflation also. So we are seeing that the projection is good. Most of the areas of India would receive either their long period average or slightly above long period average. The only region that seems to be going to get lesser is in Northeast India. South, Central, Northwest, all are going to get good monsoons. Okay, so you have to be in mind, even if the monsoon is too early, it's not good for the sowing. Okay, so timely monsoons is very important. Let's keep that in mind. Keep our fingers crossed, because we do think the monsoon will come in at least 5-6 days before the normal. So let's see how that happens. It doesn't mean that the markets are going to jump up in happiness. There's always a lag. They want to see what actually happens. And deeper. So in Thursday's paper, the headline says, SEBI bars the IndusInd ex-CEO and 4 others from the securities market, because these gentlemen knew what was happening, the kind of problems in accounting that they were trying to cover up and which have now come out. The stock would fall, and it seems that some of them have engaged in insider trading, that is, sold their stock of IndusInd before the information was made public, which is an unethical practice. So again and again, corporate governance has to be given a lot of importance when you're making investments in the equity of a business, of a company. If you do not have ethical standards, high ethical standards, then we never know when those profits are going to fizzle out, and equity investors are held holding a lemon. One should be very careful about this matter, is what we think. Okay, and there's also an article inside. Listed banks Q4 net profits rose 4.4%. Okay, but net interest income grew at a slower pace of 7%, as the net interest margin contracted to 3% in FY25 from 3.2% the previous year, as deposit repricing took full effect. So Indian banks were enjoying an unusually high net interest margin. That is the difference between the lending rate and the borrowing rate, which is a fixed deposit rate, was pretty high, and they were making more profits than normal. But now, as the deposit collection is slackening, they need to be paying a higher rate for deposit. RBI is wanting to reduce interest rates, so lending rates will fall, and over the year, you will see lower net interest margins, and combine this with a lower loan growth. Okay, so we could see slowdown in banks for this current year till loan growth picks up again. Okay, so that is something to be kept in mind as we go into the next paper. All right. So the Reserve Bank of India's annual report came out, which generally is a gold mine of data and information and takes time to study. But some of the things that have come out is that the Reserve Bank would like to review monetary policy framework in the current year. Very important because the RBI has stated that they would like to keep liquidity at a good level so that transmission of interest rates happens effectively. If you don't have enough liquidity, whatever the RBI does, either increasing rates or decreasing rates, it is not going to be felt at the lower level. Of course, it is more important when they're decreasing rates, that the liquidity is important for transmission of the same. So we did have a lower liquidity all of last year, and this year the RBI is focusing on providing sufficient liquidity. Okay, so here they also want to put some frameworks in place as to how much minimum liquidity should always be there in the market. So they are talking about at least 1 to 2% of net demand and time liabilities of all banks put together, and we've been somewhere around 0.6% kind of thing, and they probably want to take it up. So one can assume that there would be greater liquidity during the year, which is good for the markets as a whole. They're also talking about how inflation will be measured. So inflation has a inflation in the RBI's policy says 4%, and the tolerance of plus or minus 2. That means they are saying the 4% is central. It could be anywhere between 2 to 6% is the inflation band that they're looking at, and they would like to keep it at 4. But economists and RBI's view that the way the measure inflation should be taking out food and fuel, because food prices are more driven by supply and not supply issues and not interest rates issues. Just because interest rates are lower or higher, it's not going to impact the consumption of food. So food will be taken out of the inflation, and so on with fuel also, and they'll come out with a core inflation measure with which they will look at it. Okay, so we'll look forward. They also want to take a deeper look at how the liberalized remittance scheme is operating, and want to make changes. It's not clear what kind of changes they want to make. It could be to make it a little easier for LRS to happen, or they want to make it stricter. I don't know. There doesn't seem to be much. But there's also going to be a lot of attention on how the forex reserves are going to be managed. Okay, so the forex reserves need to be diversified given the weaponization of forex reserves by the developed market, the developed countries. So they would want to be away from the US dollar and also look at alternatives apart from gold, other currencies also. And the idea is if they can get exporters to denominate their trades more in rupee terms, it would take away some of this pressure and diversify our trade away from dollar denominated trades to rupee denominated trades, which would be helpful. Okay. We also spoke last week about gross and net foreign direct investment, because the net FDI seemed very, very low at only 0.4 billion, whereas the gross was 81 billion. And I did say that much of this, there were large outflows because of disinvestments. And so there's an edit now on Friday today that the foreign investment dynamics must be studied carefully. There's a worry as to why is so much being remitted out. If India is such a great economy, then why aren't these surpluses that have been generated in India by private equity investors reinvested in India? Why were they sold away? Okay, they were sold away because of high valuations. They are commercial entities. It was a great time for them to book profits. They booked profits. Okay, but why are they taking it back? Are they not viewing the business environment in India as good, or are they not confident of demand in India? What is the issue? I think requires a lot of deep study. And there's also the data that has been pointed out in this article that while large Indian conglomerates have not been investing as much in India, they've been investing abroad. So there's been an outward remittances for capital investments into businesses abroad, almost $29.2 billion. Okay. So again, needs to be examined. Why is this happening? Because we want a greater capex in India, and deeper issues of business confidence. Is it good or bad? Okay. So as a result of all these, and then we had the great news day before yesterday that the International Court for Trade in the US has ruled that the US president was overstepping his authority in imposing these tariffs, and hence these tariffs are not valid and cannot be upheld. That resulted in markets going up in happiness and the dollar strengthening, but US yields still went up. Whatever happens, US interest rates are going up, to keep in mind. This is significant in one way, but this is a much lower court, and it has to go all the way up to the Supreme Court to see what happens. And there are different kinds of thinking that some of the sections under which the tariffs have been imposed, the US president is well in his authority to do so. Okay, and there may be some tariffs which would not be in these covered by these three sections. So the way to do it is whatever is beyond these three sections is to look at sector specific tariffs, which he can do so, which could be worse. Okay, so every day the flip flops happening, and no one can say with certainty that X would be the outcome or Y would be the outcome. We have zero idea. But India as a nation is progressing with its trade talks with the US. It has progressed with its trade talks with the European Union. So it's making headway there. So regardless of tariffs, India is making efforts to improve trade with the larger trading partners and stabilize itself, which is a good sign if you ask me. Okay. Gold fell about 1% during the week because people were more optimistic in general. Okay, US stock markets went up 1.8% with the initial happiness of trade talks proceeding well with China. I don't know how they will be next week. Okay, oil has been where it is. Dollar strengthened slightly by 0.2% only. Okay, and even the rupee strengthened at 0.2%. The Nifty was down 0.4%. Initially, there was it opened well and then came back down. I think more than anything else, it is going to be earnings growth in India that is going to be driving the stock market. While there would be a lot of noise around everything like tariffs, etc., going round and round, keep your eye on earnings growth and let that be the decision maker for the investments. So that's all for this week, folks. Thank you so much.